China has been controlling the price of silver for a long time, really because it needs it as an industrial metal. But India has become a major buyer, really, again, for industrial purposes, because India is ramping up its ESG credentials. The government is encouraging and I think even subsidizing the production of photovoltaic cells. And so, I mean, Reliance Industries, one of the major conglomerates in India, has recently opened a factory which produces 5 gigawatts of photovoltaic cell output. Needs a lot of silver. And so where do they go? I mean, it looks to me like they've been standing for delivery on COMEX, where, I think over 1,500 tons has come out this year. We're talking about quite serious quantities, and stocks in the vaults, free stocks as opposed to stocks which are actually sort of held by ETFs or other serious holders, as it were, long-term holders. That liquidity is actually diminishing very substantially. So there's a huge squeeze. And of course, nobody on the short side in the paper markets can close their positions. It is actually, I think I can see the possibility of a crisis in the bullion banking community. I mean, not just on silver, but also gold, where they cannot close down their position. And if you look at the producers on COMEX, when we had the spike up to $1,900, was it September 2011 or 12?
Yeah, exactly.
The producers category was net short of about 200,000 contracts. This time, they're short of less than 50,000. So you can see that the burden is actually on the swaps, and they can't escape from it. They can't turn around and tell the miners and so on, look, sell your production forward so you can guarantee your cash flows, which is, the old story that they do, because, the miners aren't having it anymore. They're not idiots. So this is a squeeze. Yeah. Under normal circumstances, you would expect the purchasing power of paper currencies to drive the value of gold valued in those paper currencies. But we could be moving into a situation where this sort of imbalance between the Chinese demand and the supply in the rest of the world could actually force the pace, raising the value of gold, if you like. I mean, I don't like the word intrinsically, because there's no such thing as an intrinsic value, because you value something against something else. But, on its own, gold in terms of its purchasing power could increase very substantially, measured in commodities, oil, goods and services, whatever, because of this factor. In other words, it's not just the paper currencies driving towards their own demise. There is also an end coming from the gold side as well, because of this accelerating demand from the Far East.
China has been controlling the price of silver for a long time, primarily due to its need for silver as an industrial metal. However, India has also emerged as a significant buyer of silver, driven by its efforts to enhance its ESG, environmental, social, and governance credentials. The Indian government is encouraging and subsidizing the production of photovoltaic cells, which require substantial amounts of silver. For instance, Reliance Industries, one of India's major conglomerates, recently opened a factory with an output capacity of $5 GW of photovoltaic cells, demanding a lot of silver. India's increased demand for silver has led to substantial withdrawals from COMEX, with over 1,500 tons being removed this year alone. This significant outflow has severely impacted liquidity in the vaults, particularly the free stocks not held by ETFs or other long-term holders. The diminishing liquidity is causing a squeeze, and those holding short positions in the paper markets find it increasingly difficult to close their positions. This situation is creating a potential crisis in the bullion banking community, affecting both silver and gold. The producers on COMEX, who were previously net short by about 200,000 contracts during the spike to $1,900 per ounce in 2011 are now short by less than 50,000 contracts. This shift indicates that the burden of these positions has fallen on the swaps, which are unable to offload their risks to miners and other producers. The imbalance between Chinese demand and global supply is pushing the value of gold higher. While traditionally, the purchasing power of paper currencies has driven the value of gold. This dynamic is changing. The increased demand from the Far East is forcing a revaluation of gold's purchasing power, independent of the paper currency's trajectory. This could lead to a substantial increase in gold's value when measured against commodities, oil, goods, and services. Silver, although not traditionally priced as money, exhibits significant price movements in tandem with gold. Historically, when gold prices rise, silver prices tend to rise at twice the pace. Given the current supply constraints and industrial demand, silver could outperform gold even more dramatically in the near term. For those willing to take on a bit more risk, investing in silver could offer greater leverage compared to gold. The silver-to-gold ratio, currently higher than historical norms, is expected to decrease, potentially offering significant returns to silver investors. The current ESG-driven demand for silver, coupled with diminishing supply, is likely to drive silver prices higher and potentially destabilize the markets. This scenario is not just about industrial demand, but also about a structural shift in how silver and gold are perceived and traded. The paper markets, which have operated on credit without significant physical delivery, are now facing a shift towards cash for physical transactions. This change is draining Western silver stocks into Asia and could precipitate a crisis in the paper markets, potentially taking out bullion banks.
It's a fascinating situation because silver is not priced as money at all. It's not valued as money. If it was valued as money, we'd be looking at a gold-silver ratio back in sort of, Sir Isaac Newton's levels, 15 times, whatever. So it's definitely not. Yet, the thing that's fascinating is that when gold runs, silver runs twice as fast. So it does have this sort of moneyness, if you like, inside it, even though it is not priced as money. On top of that, of course, we've got, as we were talking, we've got the shortages and the squeeze in the paper market and the lack of liquidity, which is driving the price. I mean, I can see silver actually going more rapidly than twice as fast on the upward direction as gold. So, for people who can stomach a little bit of risk, and there's no sort of extra return without some sort of risk, then it actually could be a good way of getting to gold. Go via silver. If you can take the risk, go via silver. I would expect to see silver outpace gold, certainly until you get the silver-gold ratio down to somewhere between 30 and 50. I can't be more precise than that. At which point, I think I would probably reassess the position. I personally have quite a bit of silver for that reason. I want to get as much leverage on the gold thing without going to a bank and saying, look, here's my collateral.
Yes.
I've no longer got it. I don't want to go into that game. No, thank you. I really do think that silver has a role to play here. And in the very, very short term, there is no doubt that this ESG rubbish is creating enormous demand for silver. There is no supply there. And on those grounds alone, it's going to drive silver a lot higher. And it's going to break the markets. And this is something actually I'd be very interested in your view, Andy. What I see is after 40 odd years of paper markets and the actors in those markets being entirely used to a situation where delivery never really takes place. And it's just credit. The whole thing is done on credit. It's a mountain of credit, which can be expanded, contracted, whatever. We're now in a situation, I think, where that credit is now being encashed for physical. This is really what it boils down to. I mean, we see the deliveries on COMEX, which is never meant to be a delivery market. We see how this stuff is being drained out of the West into Asia. So we're looking at, I think, a potential crisis in the paper markets, which could actually take out the bullion banks.
India's increasing silver demand, fueled by its ESG initiatives and photovoltaic cell production, has led to substantial withdrawals from COMEX. Over 1,500 tons of silver have been removed this year, significantly impacting liquidity. The diminishing free stocks, coupled with sustained industrial demand, have created a squeeze on the short positions in the paper markets. Bullion banks and other short sellers are struggling to close their positions, heightening the risk of a financial crisis in the bullion market. This squeeze is not limited to silver. Gold markets are similarly affected. The producers on COMEX, who were once heavily short, are now significantly less so, indicating that swaps and bullion banks are bearing the brunt of these positions. These institutions cannot offload their risks as they used to, leading to a precarious situation where they may face significant financial strain if forced to deliver physical gold and silver. The traditional dynamics of gold valuation, driven by the purchasing power of paper currencies, are shifting. Increased demand from China and other Eastern countries is forcing a revaluation of gold's intrinsic purchasing power. This shift could lead to a substantial rise in gold prices, independent of the fate of paper currencies. As these currencies edge towards their demise, the intrinsic value of gold, measured against commodities and services, is likely to increase dramatically. Silver, despite not being traditionally valued as money, tends to outpace gold in price movements. When gold prices rise, silver prices typically rise at twice the rate. Given the current supply constraints and industrial demand, silver could outperform gold even more significantly. For investors willing to accept more risk, silver presents an opportunity for greater returns compared to gold. The silver-to-gold ratio, currently higher than historical averages, is expected to decrease, offering significant gains to silver investors. The current demand for silver, driven by ESG initiatives and industrial use, coupled with supply constraints, is likely to drive prices higher. This demand is not just a temporary spike, but reflects a structural shift in the market. The transition from a paper market dominated by credit to one where physical delivery is increasingly required is straining the traditional mechanisms of silver and gold trading. This shift is draining Western stocks into Asia and could precipitate a crisis in the paper markets, potentially destabilizing the financial institutions involved in these trades. The situation in the bullion markets is indicative of broader economic trends. The manipulation of silver and gold prices through paper contracts is unsustainable. As demand for physical delivery increases, the true scarcity of these metals will become apparent, leading to a significant revaluation. Investors who recognize this shift and position themselves accordingly will benefit from the resulting price appreciation. For American and allied citizens, the strategic accumulation of gold and silver is not just about financial security. It's a safeguard for national and personal sovereignty. As global confidence in fiat currencies wanes, holding tangible assets becomes crucial. In times of geopolitical tension and economic uncertainty, these metals provide a buffer against inflation and financial instability. By diversifying your investments to include gold and silver, you not only protect your personal wealth, but also contribute to a more resilient economic foundation for your country. Remember, in the game of global finance, being prepared and proactive can make all the difference. Investing in these tangible assets aligns with the strategies of central banks and major investors who recognize their inherent value and stability, helping shield your wealth from the erosive effects of inflation and global economic uncertainties. If you want to stay most up-to-date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.